Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today are my co-hosts, Randy Hargett and Kyle Conroy. Today, we're going to talk about disability insurance and how to determine if you need it. So, Randy, you are, 4 or 5 time repeat a Wiser Retirement uh, guest. So thanks for coming back and doing this.
Glad to be back.
And Kyle, this is your first go around
Yes,
on the
sir.
podcast. So thanks for joining us. I think everyone remembers Randy, or if you're a Wiser client, you've needed any insurance services, you've worked with Randy. But Randy, tell us a little bit about yourself and your business real quick, just for our new listeners.
Yes, I'm a 22-year long-term care insurance specialist with a little bit of life insurance mixed in there over the years, but mainly been focused in long-term care. And so when we have conversations about things like we're going to discuss today, we bring in other specialists on that, and that's why we brought Kyle in today to discuss disability.
So Kyle, just to be clear, you are not an agent yourself, but you're the wholesaler that supports agents. Is that the correct way to describe that?
Yeah, I am a licensed agent. I actually started my career as a financial planner, and then I transitioned over to this company, Disability Insurance Services. So we're a wholesaler in the market where I'll help agents like Randy basically brokerage out for when they're looking for any disability insurance needs, more on the individual side. But that's correct. I generally don't go on the application for simpler terms. So.
Got it. All right. Well, that makes it makes the conversation a little less unbiased when we have the wholesaler here, not just a bunch of agents selling disability insurance, right?
Right.
All right. Well, I chose this topic because we kind of have hot points every year that we focus on as a firm, and I don't know if I've ever really talked about this publicly, but we few years ago, it was estate planning. Okay, let's make sure all of our clients are really buttoned up with estate planning. This year, we're really focusing on disability because there's a few cases that popped up that I determined that, man, these people didn't even enroll for long-term disability inside their open enrollment at their company. And that's I always thought that was just kind of a no-brainer. But the reality is that a lot of people don't understand disability, exactly how it's applied. But I believe, Randy, you can correct me if I'm wrong, you have a better chance of being disabled than using your life insurance policy by dying. Is that a correct? I don't know the exact percentages.
That is true, Casey, especially if you compare it to term life insurance. There is a much greater chance of being disabled and having that financial burden than it is dying during the life of a term policy.
So let's just kind of dive right into disability insurance and keep it high level, but let's talk about short-term disability versus long-term disability. What defines those two?
So generally with the short term, what we're looking at is it's going to be about a benefit period of a year. Anything beyond that, some people can argue that is it 2 years, 1 year. Anything beyond that is generally what we would consider long term. So a traditional long-term disability policy is going to be to age 65 or to age 67. Those are the two most common ones that we see. Depending on the carrier and occupation classes and things like that, sometimes they'll drop it down to either maybe a 5-year or a 10-year. But generally speaking, that's going to be the two kind of difference makers there. As a 1 year or 2 year versus to age 65 or 67. Your waiting period or your elimination period also plays into that. So obviously, if someone's going to have a 1 year benefit period, your waiting period or elimination maybe, it could be 2 weeks, it could be a month, something like that. With the long-term disability plans, doesn't matter if it's a 10-year or to age 65 or 67, we'll generally see like a 90-day elimination period. So that's kind of the questions that we'll get a lot of times from clients is it's like, well, what happens in that kind of intermediate period where, what if they'll just think something small in the sense of, rolling their ankle or hurting their knee or something like that, and they're just going to be out for a couple months. That's obviously where a short-term policy is going to come into play, just because with the long terms, it's something where you'd have to be out of work and unable to work in your occupation for generally it's like 3 months, so 90 days before that benefit period gets triggered. And so that's kind of the main differences, the nuances between the two. Because from a rider standpoint, a lot of times we'll see most of the same riders offered. So it really just comes down to that benefit period.
So in the let's say talk about short term, you said that's 1 year. So if really from a financial planning standpoint, if you have a year's worth of expenses saved up, then you could typically avoid having to purchase a short term policy if your company didn't offer it already. Um, by having that, the problem is that most people don't have enough savings saved up to get them from where they are today to age 65 or 67.
Right.
And I'm glad you said 67, by the way, because most policies I see stop at 65,
Hmm.
but yet full Social Security is now 67. So
Correct.
is it just that the industry is just now catching up in their policies to the Social Security's change in the Secure Act?
Yeah, now for a few years they've had to age 67, but I definitely think that's part of it. As you know, within the last, I mean, probably a decade plus now, we've seen people, even if whether their retirement age was still 65 or not, we're seeing them work longer into their, upper 60s. We even have some clients
Yeah.
that work into their 70s. We'll see some clients that are actually applying for disability insurance, at age 70, and it's unique occupations in
Oh,
that
wow.
sense, but we do see that a lot of
Right.
times. So it is nice that now you can kind of dovetail that into the typical retirement age of 67, and that way you know that you're going to be covered through that age. Yep.
So in our planning, that's something we have to think about. Do we have enough cash to cover the short term? If we don't, then a short term policy could be added for sure.
Yep.
All right. So I think this is an obvious question, but why do we need to buy this? I mean, why should we have this coverage?
Yeah, so the main thing, looking at disability insurance from a few different angles. One, just being protecting your financial security, right? Your financial future. One thing that, I always love to ask clients is, what's your greatest asset? You just kind of sit back and let them talk for a second. And the obvious answers, they're always like, my house, my car, the
Mhm.
nice shiny boat that they just bought. And that's where, it's kind of, I would say disability insurance is more of a educational product because a lot of people either don't know about it or don't think that they need it. So the educational part comes in because we're like, no, your greatest asset is actually your ability to earn an income. Because
Yeah.
once you lose that ability to earn an income, meaning you're disabled and unable to work, out goes the expenses for, sometimes it could be tough to pay a mortgage, the boat, the house, the car, all those things come into play. Looking beyond that, for agents like yourself, where you're doing retirement planning and things like that, it's really tough to make investments if you don't have money coming in the door, right? It's tough to keep pushing money out for different kinds of things. So
Right.
that's kind of the starting point. Um, you know, it's the other thing is a lot of times someone will say, well, maybe there's one breadwinner in the family, and it's like if whether there's it's equal incomes coming in or one makes significantly more than the other, if as soon as some of that money coming in is not available anymore, now you have to start making lifestyle changes. Now maybe you have to downsize a house. Now maybe you're moving your family and your kids have to go to a new school district. So all those things like that, because regardless of what a family's income is, they're used to a certain lifestyle, right? That you become accustomed to that. So that's kind of how we look at it, is whether you have some savings in the bank or whatever it is. It's really if you're reliant on your paycheck, you're relying on that money coming in on a monthly basis, then disability insurance is going to be suitable for yourself.
What I mean, what about Social Security disability? Why couldn't you just go on that instead of buying a disability policy?
Yeah, so lot of limitations to Social Security. The starter, I'll say, the stats that I've seen are as much as 70% of applicants get denied for Social Security. So you have to be totally disabled to receive those Social Security disability benefits, as opposed to so it couldn't be a partial disability. I guess what I'm getting at. And with these
Yeah.
with these individual long term disability policies, they're much more comprehensive in coverage because obviously if you're totally permanent disabled, then you're going to receive your benefits. But there's also a rider on there called a residual rider that if you were partially disabled, so it's because that's very commonplace where it's not you can't work at all full time, but maybe you can only work 2 or 3 days a week because you have to go to rehab, therapy. You just need rest, to recover, whatever it is. They'll still pay an equal percentage of your benefit. So that's another reason. And then the maximum benefit amount, I think recently I read it was maybe 3,800 or 38, 22 or something like that
Mhm.
was the max Social Security benefit being paid. So there's that. The elimination, there's a 5 month waiting period for it. So there's just a lot of things that come into play Social Security is a great benefit that's being provided currently by the government to have. I just wouldn't necessarily want, myself or my clients or a family member to be reliant on that, just because the
Yeah.
individual policies are much more cumbersome in coverage. You can get higher benefit amounts and things like that. And then the other aspect to that is a lot of the carriers, depending on the market and things like that, they'll have a Social Security benefit rider. So what that means is you still have your base benefit from these policies, and then there'll be a secondary benefit that's called like their Social Security benefit rider essentially. But if you get declined by Social Security, that secondary benefit will be paid. But if you were to get approved when you applied for Social Security, then that second benefit won't be paid, and so you'll still get your base benefit and then the Social Security. So it's nice, kind of peace of mind, I guess, to have that Social Security in the background, but it's not something that, I think that anybody should just 100% be relying on.
So when you think about disability, is it pretty commonplace that it covers 50% of is it your last year's income? Is that what it goes off of? How are the benefits determined?
Yeah, it's generally the kind of the golden rule, if you will, is about 60% of your gross. So for easy numbers, just to kind of work backwards, what we always say 60% would, for every 100,000 of gross income on an annual basis, that's going to be about 5,000 a month. Just right, 5,000 times 12 is 60,000. So there's your 60%. Each carrier has their own algorithms that they use, so it could be plus or minus. When we run competitive analysis, that base benefit for every client won't be completely equal across the board. They'll generally be within a couple $100s of each other. But 60% is what we say, and kind of the questions that a lot of clients will ask, like, well, this is still less than what I was making. The reason being that there has to be some sort of incentive to get back to work, right? Because, most people in this world, if you're receiving 100% of your income while not working, it's tough to motivate them to get back to work. So the idea is to, be there as a support system, financially, for if something were to happen and they're unable to work, with the hope that once they get healthy again and are able to get back to their occupation, then they'll do so. And the reason being so that they can get their full income back. So those are kind of how we look at it from a percentage standpoint. But again, every carrier is slightly different.
So obviously the more income you have, the more you should be expecting to pay in premiums for a private disability policy. Is that a fair statement?
Definitely. Yeah. The two main driving factors are going to be your age and what your income is. Because if all things being equal, person's making the same amount of money from one year to the next, that second year when they're a year older, they'll be slightly more expensive, just naturally, the inherent risk that comes with that. Yep.
So is there is there a cost of living increase built into most of these policies, or is it just a flat dollar amount?
No, good question. So there's a few different riders that these carriers will include. One is called your COLA, or cost of living adjustment. And so that's for every year that they were on claim. That next policy anniversary, it'll increase. It's generally going to be 3 to 4%, depending on inflation and things like that. So that each year your benefit while on claim will increase. The other nice feature that a lot of these carriers include on their built into their policies, it's the automatic increase rider. So it'll be for the first 5 or 6 years of the policy without being on claim. On the policy anniversary, your benefit is actually eligible to go up. Again, it's generally 3 to 4%. Obviously, your premium will be reflected with that as well, but it's kind of an inflation guard for the first 5 to 6 years of the policy being enforced, and then it falls off after that. But that's just something to get started with. And then you've got, again, that COLA rider for, let's say, 5, 10, 15 years down the road. If, God forbid, somebody goes on claim, then at least they can get that inflation guard built into it moving forward. Just because, as we all know, especially what we've seen these last few years from an inflation standpoint, let's just say you have a $5,000 or a $10,000 benefit right now. That dollar for dollar value is not going to be the same in 10, 15, 20 years down the road. So very, very important rider to include.
Casey, I've got a question. Kyle, is it not true that there are some policies out there that reflect specifically on the job that you became disabled from, that you can't work that job, but you could work another job and there's still some benefit available? Is that correct?
Great question. Yes, sir. So kind of the definition basically of these disability insurance policies are, if you're unable to do your duties and responsibilities of your occupation, you have an attending physician statement that signs off on it, then you will receive that benefit. There's two critical riders that we look at. They're commonly known as true own occupation. So there's two levels to it. So the modified and then there's true own occupation. Under both definitions, the carrier will never force you back to work while you're on claim. The benefit of that hire when the true own occupation is that same thing. You're unable to do your exact duties, but maybe you could work in a different occupation altogether. Then you could still receive the benefit from the carrier and receive that secondary income that you now have in a new occupation, as opposed to with the modified definition. If you were to go seek what they'll call gainful employment, if you were to seek that, then there would actually be an offset from your benefit to the new income. So it's a lot of it's a valuable rider. It's very occupational driven. And what I mean by that, the easy example is, let's say, a surgeon. If a surgeon were to become something, they could have carpal tunnel syndrome or something could happen to their wrist because of what their occupation requires from them from a duty standpoint. They're obviously now unable to provide surgery, right? If they've got something going on with their wrist, elbow, shoulder. But maybe they're not totally disabled in the sense they could still a lot of times go teach at maybe the local university, right, to the different residents, or they could find a secondary occupation because again they can't be a surgeon at this point. They could find a secondary occupation still in the medical field. Now they would essentially be able to collect their benefits and receive that secondary income without an offset. So it's again,
So is that a standard policy, or are there policies out there that wouldn't be written that way that you should avoid?
Yeah, I wouldn't say to avoid it. Generally, when we run the illustrations, again, this is where kind of what the specialist comes into play, and just having working with proposal specialists who understand, are experts in the field and understand what each occupation is requiring. Generally, what we'll see our kind of base policy that we'll send out would be that modified contract. If once we see again it's a surgeon or somebody like that that's a little more hands-on, that's kind of unique in their occupation, where something that would be disabling to their occupation but not a more general occupation, that's when we'll throw that true or knock on. The nice thing about these policies is they're completely customizable. So for example, if Randy has us run some illustrations and we provide them and they come back with a modified definition, we go to present it to the client and we explain the differences of those two, kind of the nuances of those riders. And they're like, you know what, I really want that true own occupation, just peace of mind. Or maybe they have something in the back of their mind that if they were to become disabled, they would go work in this other occupation. Maybe they have family ties to something. Then we can always go back and revise those illustrations to make sure we have it on there. Mm-hmm. So yeah, we can look at both, but we'll definitely explain the differences just because you are paying a significant premium for that true own occ. But again, depending on your occupation, it may be worth it.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
So let's shift gears to business owners for a minute. So you think about a business owner who is disabled, but they still own the company. So they're still getting probably a K-1 and profits.
Yep.
How is that typically handled? Because I'll have to go back and look at this, but we pay for short-term and long-term disability for our employees as an employee benefit, but I'm pretty sure I'm excluded from that. Like I don't get to participate. Am I thinking about this correctly? Is that normal?
So they'll definitely look at it's very unique case by case. The main question they'll have is what are an individual's residuals coming in? And sometimes if those residuals hit a certain amount, then there can be an offset there. Business owners are unique, but what the main thing that we generally look at, let's look at a small business owner, for example. There's another disability on the same disability chassis. It's called business overhead expense. And that's a product that we often, it's so undersold to small business owners, which is a shame. I think the last stat was like 8 or 9% of small business owners have it. But Essentially what that does is, and when I say small business owner, let's look at an example of like a single practitioner at a dental office. So they'll
Okay.
have employees, they have a front desk staff, they have a dental assistant, they have a dental hygienist, they have $30,000 of overhead coming in every month, but the business is solely reliant on that single practitioner dentist. So business overhead expense, if something were to happen to that dentist, they'll have the benefit coming in to pay everything from their overhead to restock it. It could still pay their employee wages. It could pay their insurance premiums. The intention is to keep the lights on at the office. The max benefit period on that is generally going to be about 2 years. But the intention is to give the business owner a 2-year window to make sure that, look, they either can get healthy in that 2 years and come back to work, or maybe it's something where it's more catastrophic and they're not going to be able to come back to work. Okay, now at least they have a 2-year runway to try to find a seller for that business rather than having to short sell it, right? Because the studies show on a small business, they go belly up without money coming in the door within months. So
Yeah.
what I'm getting at is that's where we like to start with the small business owners. And naturally their next question is going to be, okay, and then I'll also pay my income, right? And it's like, well, actually that's the one main thing that it doesn't pay. And that's where now we pivot to individual disability insurance. So in a perfect world, they would have individual DI to pay their own income coming in, give them a benefit,
Yeah.
and then the BOE to keep their business open, pay their staff and things like that. So that's kind of how we approach it with small business owners. Obviously, large business owners is a little different. But if you are in a larger business, like you said, you may have some K1s and other residuals coming in to where it may, can offset that policy, but they could still nonetheless have disability insurance.
Interesting.
So what you're saying there, in Casey's example, is that he has the group long-term disability for all of the staff at Wiser Wealth, but he would probably have to purchase an individual long-term disability policy for himself
Correct.
as the business owner. Okay.
And you can still participate in your group policy. You'd have to talk to obviously your group rep because there's so many different ways that they can put this thing together. But what we actually see a lot, not to pivot away from it, but with business owners like that, there's what's called guarantee issue plans, and that's where we're seeing the market really head towards right now, where you'll have an executive, so the business owner puts a group LTD plan in. And let's just for typical numbers, let's call it 60%, and it's going to be capped at like $6,000 a month. So that's great for most of your employees. That $6,000 a month, even if it's taxable, is going to give them a significant portion of their income. A lot of times we'll see the business owner or the if it's a larger company, the business execs, they're all exceeding whatever that cap of 6,000, 10. I've seen $15,000
Right.
caps. They're going to exceed that. So you still get to participate in that group LTD plan, but our recommendations come in. It's like, okay, now we should put something else in for the execs or the ownership team to make sure that we get your income, because what we commonly see is they'll think that when they are doing a great job of providing this benefit for all their employees, the downside is they think they're covered in that as well. They just hear 60%, and they're like, no, we're all covered. We're good. We got 60. When that cap still comes into play, it doesn't matter what your role is at the company. That cap of X, whatever it is a capped for everybody.
Yeah.
So that's where we'll come in,
Yeah.
just because, again, the higher the income earner is, the more coverage they're going to need, and they're underinsured under those group LTDs. So with these individual plans that we're discussing today, we can stack these on top just to make sure that everybody gets trued up, and we do a nice there's a plot diagram that we can put together, but it's very, it's a visual learner at that point, because you see it and it's like, wow, it's like all these people have coverage, except the higher the income grows, now they're so underinsured. And again, it's everyone has this kind of lifestyle their family is used to living, used to a certain amount of income coming in. So it's just a nice benefit added. There's a few different ways they can put it together, but it's basically like an executive 162 plan. That's kind of the IRS code that they use. But it's guarantee issue. So that's the biggest thing, which is similar to group. They're not going to do medical underwriting and things like that. The only difference is that group LTD plan that you were discussing is, everyone's more of a certificate holder. So it's, there's some inherent differences, but rates can go up down the road. It's not portable, right? It's not permanent either. In a couple of years, if the carrier doesn't like that risk, they could pull that block of business from you. Whereas once we stack these guarantee issue plans on top, there's still individual plans for each member. So it's permanent, it's portable, they're level premium, so they can't increase. But it's a good executive benefit. So sorry for that long-winded answer there. But so long story short, you can still participate in that group depending on how it's set up. And then you just may need some individuals stacked on top.
Got it. What we see these advertisements with Nick Saban and Deion Sanders for the Duck for Aflac.
Yep.
Is that disability insurance or is that something different?
So Aflac does a great job of marketing. First off, everyone knows the Duck.
Yeah,
They have
Yeah.
a full suite of different products. It's more of a short-term disability. And like I was saying earlier, this is where people in the industry can argue, is it 1 year, is it 2 year? With Aflac, they will go up to 2 years, so 24-month benefit period. There's still some inherent differences on that, but it is more of a short term. They also offer critical illness, which is kind of another sister product of disability insurance. It's like it sounds.
I think that's how. Yeah, I think that's how I would identify them more. Is like, if you have cancer, they're going to send you X amount of dollars. I know that for my wife's a school teacher, and they had this Aflac, like maybe an Aflac, I don't remember, policy, but basically went down the list. If you lost your arm, you got paid this. You got cancer, you got paid this. And I started looking at the numbers. I'm like, all right, so we're going to pay $120 a month for this. And if you get cancer, I'm going to get 10 grand. And I don't know, for most of our listeners, that 10 grand really makes a difference. And so I started looking at that going, I think this is a really good deal for Aflac.
Yeah,
because honestly, I'm like, you're probably not going to have cancer in the amount of time that this covers, and then if you do, you're gonna get 10 grand. That's it. I mean, maybe
right.
give me a check for 100 grand. I might be interested in paying the $120 premium, but I'm not saying it's not needed, and maybe for more blue collar type families, this makes sense, but I don't know. What is your take on? You don't have to say if you like it or don't like it. You can just tell me what the purpose of it is. But
No.
that was my first. That was my first experience with it. I was like, I don't know if 10 grand really helps me.
You make great points, and I'm not, I don't represent Aflac at all. That's not a carrier that we work with. They're just a large company. They've got their own
Right.
people working it. But I will say, to the credit of critical illness, the product as a whole, because there's a few other carriers that do offer critical illness, it can be very beneficial, because the one thing, like I was saying earlier, your question about disability insurance, how much can you get? It's all income driven. So you can get about 60% of your gross with individual DI. With the critical illness, you can actually, it's more like life insurance, where you can just pick a value. You can pick a benefit amount that you want. So, we're working a case right now. The person wanted a $500,000 critical illness benefit for their spouse, because their spouse is a stay-at-home spouse. And so they don't have an income, so they can't get disability insurance.
Mm-hmm.
So now this is a great product, because now it's okay. Now you have a $500,000 that, if, again, God forbid, they come down with cancer, a stroke, paralysis, coma. So it's more critical illness things, as obviously we mentioned, but they will receive that. And still, on a large scale of things, it's kind of cents on the dollar. So it can make sense for that, just again, for protection and peace of mind of the more extreme things that can happen to an individual. But to your point about looking at, the whatever they were charged, $120 for a $10,000 benefit, that's kind of where my mind goes with short-term disability. And again, it can be a great product for individuals who really need it. Let's say someone more in a blue-collar marketplace, maybe they're a painter or in construction or things like that. They may need something to where if something happens, they hurt their knee or ankle or something, they can't climb on a ladder for 3 months. Okay, then that's great for benefit to come in. But when you start looking more at some of the more different occupations, you are paying somewhat of a significant premium for whatever X amount of dollars it is. But being that your benefit period, let's call it 6 months, there's going to be a break-even period where after you pay premiums for, let's say, 5 years, you may exceed whatever the total benefit for 6 months is. So do you see what I'm saying? Like,
Right.
there's a cost benefit analysis there, and that's where you have to do it. So again, whenever clients ask for short term, it's not like, no, we're not going to offer that. It's just you want to talk through that, because they love the idea of, well, what happens if I can't work tomorrow? I need something coming in a couple of weeks. And it's like, okay, well, let's look at your occupation, and there's just a few different factors you look at. So it can make sense in the right place. But otherwise, that's generally when we try to pivot more to the long term, just because that's going to be more significant. But again, the critical illness, yeah, you'd have to look at it. I don't know Aflac's pricing, obviously, but they, depending on the benefit amount, and then again, it's kind of a cost benefit analysis. Whatever that premium is, you can make an argument for it.
Yeah.
That's another
I mean,
product.
if you're living paycheck to paycheck, that's when you need that short term the most,
Exactly.
because if you don't get the next paycheck, then you're in trouble.
Exactly.
But wealth management clients, I don't know that we have any that live paycheck to paycheck. They all have reserves, so it's a little different conversation, obviously, at this level. But yeah, I was just always wondered, because every time open enrollment comes around, she wants to sign up for everything, and I'm like, I don't know if this makes any sense to sign up for that. They should pay you a lot more money. My cost of you getting cancer is much greater than $10,000. So
Yeah, exactly. So that's why sometimes, again, just working with an independent broker, someone like Randy or yourself, where you can kind of shop the market out, because there are going to be carriers that price it differently. And now it's like, okay, if you can get $100,000, a $250,000, or excuse me, benefit policy, and now it still only costs you $120 a month, now you can make an argument that may make sense. The other caveat to that, because again, in the DI world, it's always case by case. Let's look at the client, things like that. To your point, it definitely, blue collar versus white collar, it can make more sense from one than the other. But something that we do see a lot, for example, is like a CRNA, so a nurse anesthetist. That's a white collar industry. They make great money. They're 1099. And we had a case where she was like, well, if something happens to me and she falls and messes up her arm or her wrist or something? She's like, I may be back at work in 3 months, but I'm not earning any money in that 3 months because I can't be providing the care to the patients that I need. Then that's another place where it's like, okay, let's get some short-term disability, because that makes total sense. So even though it is more important in the blue collar industry, we do still see some unique occupations where it's like, maybe this does make sense in the white collar as well. But again, it just goes back to that. It's case by case, client by client.
Well, I would say that this is a point where everybody that is employed needs to pay attention, because a lot of employers do offer short-term disability in their employee package, and a lot of people have not taken it, and a lot of times it is a pretty good deal at a group level. And so pay attention to what your employer is offering, because you really need to know what options are there. And sometimes that short term through the employer is a good deal.
Absolutely.
So piggybacking on that, either short term or long term, if you're paying for that through your employer, or your employer just covers it, what happens if you go out and buy an additional policy? So did they stack on top of each other, or does one say, no, you first, then me?
Great question. So a lot of times in a perfect world, how we do is we'll dovetail one into the other. So a common long-term disability policy, it has that 90-day elimination period. And so a lot of times for a short term, even if it was, let's just, for easy numbers, let's say the benefit period was 3 months, there won't be any offset there whatsoever, because even if someone were to go on claim, by the time they come off claim for the short term, then the long term disability policy starts. And so it's a very smooth transition. Right. Even if we see it now go to 6 months or a year, that's kind of where every carrier is going to handle a difference. But generally, they'll make a business decision, and they'll still offer the full whatever you're eligible for on the long term, just because they look at it, it's like, okay, maybe for 3 months or 6 months, you are going to be receiving more than what you should, or 100% maybe of your income. But then they know that immediately after that short term falls off, and then you're just on the long term, so it's fine. But they definitely take into consideration, to your point, of what other benefits do you have, or what other policies do you have. Because if you had some group coverage that could still be, to age 65 or something like that, or maybe you're an individual who already purchased your own long-term disability. Now you're in a different occupation, your income's gone up, and you're looking at a secondary policy. They will take that into consideration, just because, again, the idea here is they want about 60% of your gross. So depending on your taxation, everything, I've seen as high as like 85% income replacement. But they will take that into consideration, because they don't want to overinsure an individual. They definitely want there to be that motivation.
But I guess my point is it'd be two separate carriers. So let's say, keep it simple. You make $100,000 a year. You're covered by your employer at 50%. So you got 50,000 coming. You've qualified for long-term disability at 50,000. Not disabled enough to be able to take SSDI. So you got employer getting paid or paying you, or the company, insurance company's paying you 50,000 long-term disability, but you also have a policy that covers you, personal policy that covers you at 50%. Do they negate each other, or do you get now 100%?
No, so at the time of underwriting is when they'll look at that.
Yeah.
So they'll say, so let's just for to make the numbers a little easier.
So underwriting, they won't let you do that.
Yeah, on the application they'll ask, hey, what other policies do you have in force? We'll say they've got this plan. It's 50%, capped at whatever it is through their employer. Yeah. The individual carriers that we work with will even say, is it taxable or not? Because rather than saying, okay, you may get $5,000 a month through your employer, but because your employer is paying it, that's going to be taxable. So let's just call it $3,500 now. So they'll allow you to still get that additional individual policy to make sure that we can get you close to that 60% gross. So it's just a numbers game at that point, but it is a nice kind of value add that the carriers will say, okay, this is taxable, so you're actually eligible for a little bit more than what it looks like on paper.
So everyone's kind of capping you out between that 60. You said you saw one at 85%, but they're kind of capping you out at that 60% range.
Yeah, they generally do it 60%. That's why we always it's like air quotes here, but 60% of your gross is just it's kind of like the golden rule in DI, just because that's across the board generally what we see. But the reason I was saying 85 is that's what, like 60, it'll be 60% is what the numbers come out to when you run the quotes. But then it could, once you take into consideration taxation, all that, your take home I've seen as high as like 85%. So does that make sense? Like it's 60% of gross, but when you look at your total numbers of take home, it's anywhere from 75 to 85%. Yeah,
because you're not putting money into the 401k anymore. Your taxable income is probably less. So yeah, it kind of backs into that. That makes sense.
I've got one more question.
Yes, sir.
I've got one more question. Are there any considerations for terminal illness disability? The only reason I'm asking that is because I just recently had a long-term care client who was not able to care for herself because of terminal illness. And surprisingly, the insurance company waived the elimination period based on the evidence of the terminal illness. So she was able to start getting long-term care claims before the elimination period. Is there anything like that available in DI?
They generally still want you to satisfy the elimination period. There are other riders, like you can throw in there as a catastrophic rider, where you'd actually have a secondary benefit come in addition to your base benefit. And that has to be, as it sounds, catastrophic. But generally speaking, the carriers still want to see that 90-day elimination period satisfied. And I say 90-day elimination because that's kind of the sweet spot for these carriers. You can customize that. So sometimes people will, if maybe they have a great short-term disability contract that pays for 6 months, so it's 180 days, then you can go on a long-term, we can go 180 days. You don't get as much savings on premium as you would think. And on the flip side of things, if you shorten that elimination to like 60 days, the premium drastically increases. So they've all kind of funneled into that 90-day elimination period. But Randy, to your question, we generally see them, they still want you to satisfy that 90-day, and then they'll pay the benefit.
Just to clarify taxes. So if your employer pays your premium and you're on disability, the disability income is taxable. If you pay your premium, your benefit is not taxable. And I assume that if you're splitting the payment with the employer somehow, that it's partially taxed and partially not taxed. And they would sort that out on your 1099, I assume.
Yeah, so generally that's exactly it. If it's employer paid, then it's going to be a taxable benefit. So that's why 9 times out of 10 on the group LTD side of things, it's always that's an employer added benefit. So it's employer paid, so it's going to be taxable. With individual DI, without telling the client what to do, that our biggest recommendation always is you should pay this with after-tax dollars. Where we see the pushback on that, either the business owner or the 1099 individual, they're always like, immediately they're like, I want the tax write-off.
What deduction?
Yeah, which makes total sense. But then it's, and again, I always say it's an educational product because this is where it's just, put on kind of your consultative hat and it's like, let's talk through this. Let's say your individual DI policy, let's just say it costs you $5,000 in annual premium. okay, depending on what your income is, sure, you can get a $5,000 a year write-off, which sounds great on paper. But let's say your benefit on that policy is $10,000. If something were to happen to you, now because you had that $5,000 a year write-off, now your $10,000 a month benefit is going to be taxable. And after 3 months of being on claim, you've probably exceeded your tax write-off right off the bat, and now your benefit is still going to be taxable. So we always recommend, at the end of the day, it's your classic, like, hey, you should go talk to your CPA about this. But that's always our recommendation, is like, this should really be an after tax, just because, again, it's that benefit amount is so important to you and your family that you want, the kind of approach that we take with individual DI is you want as much tax-free benefit for as long as possible before you worry about all the bells and riders and things like this. So a lot of times when we're looking through the illustrations, like the riders we talked about earlier, True and Knock, for example, they may want that, but then the policy becomes a little expensive, or maybe it's out of their budget, and then it's like, oh, well, let's look at a 10-year benefit period. And it's like, I would strongly advise that we go to age 67, with as much tax-free benefit, and forget about all the bells and whistles, because there's just, at the end of the day, that's what's most important for your family, is getting that tax-free benefit.
Right.
The one area I'll say where the tax write-off can make sense is, earlier we discussed those guarantee issue plans, where a business owner is putting the plan in for their whole executive team. So it's an executive benefit. A common one we'll see is like, it's 10 execs that are all getting this. So your annual premium that you're paying for that the employer is paying for the executive team could be, $50,000, $100,000. I mean, we've sold $300,000+ policies every year. As much as you don't want the benefit to be taxable, this is just a great value add that employer is paying for. So it's like, okay, it makes total sense for you to want that tax write-off. And if your executive team or the individual still want more coverage, they can go purchase more on their own. But when the numbers get that excessive, it totally makes sense for the write-off. But for an individual, what we call a onesie-twosie, for any of your clients out there that's just looking for something for themselves, you really want this to be a tax-free benefit.
Makes sense.
Yep.
Well, gentlemen, thank you for your time today. This has been very educational. Hopefully our listeners found that as well. We have a couple of episodes where we talk about things kind of around disability. Episode 212, medical costs during retirement and preparing for the unexpected. Episode 179, long-term care insurance, to buy or not to buy. Episode 126, how can insurance protect your wealth? Those are all things related to asset protection. I guess disability is a little bit along those lines, more like lifestyle protection in that case. Sometimes centered around this is Medicare. We link to a YouTube video, a Medicare sign-up process explained. Obviously, if you need to get a hold of Randy, how do we get a hold of Randy if we want to learn more about disability insurance?
Well, you can just go to my website, www.ltcstep.com, or randy@ltcstep.com.
Okay. And then that's our connection to Kyle, is through Randy. We're looking for disability insurance. Kyle, thank you for taking time to come and do this. It's always good to hear from experts on different areas, especially with disability, which I think gets overlooked quite a bit.
No, certainly. Yeah, I appreciate your time. Thank you for the excellent questions, and hopefully this was informative for all of your listeners. So thanks for having me.
Good job, Kyle. Thanks a bunch.
Thank you, Randy. Thank you, Casey.
Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, I want to schedule a consultation, meet with one of our fiduciary financial advisors. You can do so by going to wiserinvestor.com, or you can click in the episode notes as well. All right. Thanks again, guys. Appreciate it.
Thank you, gentlemen.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out.
This episode was produced by Edward Resendez.